Okay, welcome to our June 2026 monthly podcast. And my name is Brett Heine from Cornerstone Private Wealth. And as always, I'm with my partner, Dan Lesneski.
Brett, good to be back.
Good seeing you, Dan. And this month, we're going to have a kind of no slides this month, Dan, so we'll just kind of talk. But I think the word for the month could be parabolic. We're going to talk about parabolic moves because we have seen a parabolic move in tech stocks. And I remember last month during our May podcast, we mentioned that concept of sell in May and go away. Well, Dan, I'm glad we didn't sell tech stocks last month because if you look at things like the XLK index, which is the S&P technology index, that was up 20% for the month of May. So things have moved pretty greatly. If you look at the NASDAQ itself last month, the NASDAQ was up 8% for the month, and the S&P was up a little more than 5%. The Dow was the laggard last month, only up 3%. So we've had a pretty big move. Big part of what we're going to talk about today is whether it's going to continue. I don't know if you want to make a comment on that up front, and I'll share some other numbers.
Well, it's not often that you have all three markets hitting all-time highs. And I think we had, for the S&P in particular, it was 9 consecutive weekly gains. And that's only happened 4 times in the past 40 years.
Wow.
Right. So it was a pretty monumental run. A lot of the underlying fundamentals that kind of, propelled that remain in place. But I'll tell you what, it's starting to get pretty heady at some of these levels.
Yeah. Yeah, really. I'll give you some other stats that is amazing itself. But if you look at the S&P 500 for the month of April and May, because we remember last month in May, we had about a 10% move in the S&P. So I just saw a stat yesterday. It said, it's up 16% in 2 months for the S&P 500. So you might see a little bit of a change of tone in this podcast. We've been saying kind of hang on. We're thinking now might be a good time, at least in the tech sector, to be a little cautious. Certainly cautious with new money, and maybe even a little sector rotating to be a little bit more conservative.
Yeah, it was interesting, Brett. In May, only 8 out of the 11 S&P 500 sectors were red for the month of May, right? And then you looked at advanced decline line, so companies making new highs versus lows. We made a lower high in May, and really what's going on is mega cap stocks, particularly mega cap tech, are kind of masking underlying weakness in other sectors of the market. And
yes,
it's great if you have a lot of those names in your portfolio in the short term, but it's definitely something we've got to actively monitor because, you can't see a move like that quickly and not feel a bit uneasy about it.
And trees don't grow to the sky, right? Yep. So we're getting a little cautious. We're going to give you some other stats here. I have a chart in front of me. So if you look, I mentioned this 16% 2-month move. It's only happened 5 times since 1957. Okay, and if you look at I had the other occurrences in front of me, and all the other occurrences besides one appear to be during a recession. So last time it happened, they're mostly during recovery periods. Last time it happened was May of 2020, and if you remember, that was a bounce back from COVID. We had that quick 34% sell off in 23 days at the beginning of COVID. You always have a V-shaped bounce back, so you had about a 17% increase there. Then it happened in April of 2009 during the end of the financial crisis. That again, another snapback rally. Both of those were recessions because if you remember, the COVID was a brief couple-month recession. And of course, the global financial crisis was a pretty long recession. It happened in 1974, okay, after the oil embargo, and that was another recession. And the only time it didn't happen of those 5 occurrences during a recession was in 1987. And if you remember what happened in 1987, I'm not making you feel great. We know in 1987, we had a stock market crash. For those on the call that don't remember, we call it Black Monday, October 19th of 1987. We had about a 22% decline. And this previous to that, the couple months before that, the S&P was up 16% for 2 months in a row. Kind of interesting going back to 1987, Dan. That was a 508-point decline, and we call it Black Monday. It was a big thing. I think we were down more than that points-wise yesterday, right? But on a percentage-wise, that was about 23% of the market because the S&P 500 was at 2,700 back in 1987. Or the Dow, I'm sorry. Dow was at 20.
Absolutely wild.
Yeah, Dow was at 2,700 back in 1987. The Dow was at over 51,000 yesterday. So we had a bigger point decline yesterday than we had during 1987.
Well, it's interesting, we're doing enough of these podcasts now every month. You get to go back and kind of rewatch and talk about some of the things we hit on last time. And, I guess it's a little over 3 weeks since the last time we sat down to do this, and looking at looking at the situation in Iran back then, it seemed like we were slowly but surely inching towards a resolution, and oil had started to settle in, and then this past week, basically the political class of Iran has more or less stepped down. It seems like the IRGC is in control, and it's never a warm and fuzzy feeling when like the CEO of Exxon comes out and says, oil's probably going to $1.50 and people aren't ready for it. So, again,
and $1.50 he means $1.50, not $1.50.
Yeah, exactly.
Just so you know, just to clarify,
$150 a barrel. So it's one of those things. Give it another week, give it another month. Obviously, we could be in a very different situation to the up or downside with how volatile things seem to be in the news cycle. But certainly a lot of change that way. And then, heading into an uncertain period of time. The May timeframe in the summer. I don't think it was really. We started to have some tech strength in April as well, but I don't think anyone was necessarily, looking at May and saying, yeah, this is going to be a monstrous historical setup for AI this month.
Exactly.
So, it's always good after moves like this to kind of take stock, look at what's going on in your portfolio. If things have gotten out of whack, it doesn't hurt to take some profits. It doesn't mean you have to be out of the market, but you also don't have to stay in, the most crowded trades.
Yeah, well, we're not suggesting, because nobody can pick a quick correction. Yeah. We're not suggesting that we're going to have a correction this month or next month. In fact, as just a timestamp, it we're sitting here on a Thursday, June 4th, and the Dow's up like 600 points right now. Right, it was down 600 points yesterday. So, and what we hope happens, and what could very well happen, is this is really this parabolic move, as I've said many times, is pretty much isolated to the tech sector. Maybe we'll have a broadening out during the summer. Maybe money will move out of technology into things like healthcare and financial, like people were thinking at the beginning part of the year.
I mean, and if you look at performance in May, energy was down almost 6%, utilities down over 5%, consumer staples down over 3%, financials down almost 1.5%. So you have significant portions of the market that have, really lagged. Right. And, energy in particular, it doesn't seem like the prospect of additional supply is coming online anytime soon. So it'll be interesting to see how things continue to develop.
And another way to slice and dice it, I saw one of the commentators on yesterday for firm BTIG, and they do a lot of technical analysis. But he had mentioned through Tuesday, just a couple days ago, that the trailing 10-week period for technology was the best period ever. So that goes back to the big moves of 1999, the best move ever. So that was interesting. So I want to get your opinions on, Dan, a report from Goldman Sachs that was talked about in the press yesterday. It came out from Tony Pasquarella. I have it in front of me, Goldman Sachs. And one of the things he talked about in relations to whether this thing is getting too old, meaning the tech move is going to roll back over, a lot of it is predicated on earnings growth. And he has a chart here. So, the first quarter of 2026 was huge. We've outpaced the earnings expectations for the last several quarters, and by a wide margin on the first quarter of 2026. He's thinking we should be good, if you look at the research report for the rest of this year, to have continued earnings growth. If that continues to hold up for the S&P, then the market should do okay. But the problem with that is about 2/3 of the earnings growth, if you look at the first quarter of 2026, not only came from tech sector, but just even a more narrow subsector of technology, the hyperscalers. Just 5 companies represented about 2/3 of the earnings growth.
Well, one of the things that stuck out to me too, looking at earnings season, was there was a ton of beats, but there were beats for very different reasons. Right. So, you had someone like Alphabet, for example, where they, their revenues were up 22% year over year. Their cloud revenue surged, north of 60%. But then, then you look at like a Meta, right, that had a 33% increase in revenue, but a significant portion of that came on the back of laying off close to 20% of their workforce. Right. So I think, we're going to continue to enter into this period of time where I think we're going to have continued strong earnings growth. However, you really got to start to look, a little bit below the waterline and see, hey, is this truly organic growth? Is it, just like a handful of years ago, every company would mention AI in their quarterly earnings, and that was a boon. Now it's, AI efficiencies with personnel and AI spend on tokens and things like that. And you're going to start to see at some point, like you can't just slash your way into growth.
Right.
So at what point does that become problematic? But, Alphabet, Amazon, Apple, Eli Lilly, all had killer quarters, top bottom line beats. For right now, I don't see that changing, at least in the short term.
How about we'll bring up some other companies, lesser known companies, Marvell. I know you know more about the tech companies than I do. I'm looking at some fun stats. Marvell, looking at the numbers right through today, up 237% year to date, 2026. Looking at Joe, our producer here from the studio. You should have bought it, Joe, at the beginning of the year. Up 355% over the last year. Okay. And what was funny yesterday, I saw a story that said that they recently received a $2 billion investment from NVIDIA. And what's interesting is they're not even in the S&P 500. So and the S&P 500 is the top 500 companies in the world by market cap. Okay. This company, that growth path, when they do become part of the S&P 500, which they will probably this month, they're going to be in the top 50 automatically. So that just doesn't happen. Companies don't grow that quickly. It'll be one of the largest 50 companies, and it wasn't even last month one of the top 500 companies.
Well, we were talking about that yesterday too. So we were, we were doing a webinar with some of our young, professional clients and children of existing clients, and going through and just talking about kind of how the market composition has changed.
Right.
And I think the one that stuck out to me was we were looking at 2005, and of the top 10 companies in the, by market cap, Microsoft is the only company that was in the top 10 in 2005 that's still in the top 10 now.
Right.
And the slide gets updated monthly. It was already out of date because it didn't account for the fact that not Broadcom, Micron overtook JP Morgan as the 10th largest company, right? Which is just wild.
Because that chart was days old. Not
days
hours
old. Exactly.
not years old, days old.
So we're just, we're in a constantly evolving market. It's really wild.
I was reminded yesterday, I was around in the late 90s, but I had a doctor who's a new prospect, very smart guy. And it was in 1999, I always remember this, and he had about $1 million to invest in a new portfolio, and he talked to my team about it. And then he decided to go with his son. And his son, he said, was a whiz kid. His son was like 24 at that time. And I remember the number. His son had a portfolio construction of, it was like 15 stocks. He sent me the portfolio with the percentage returns. But for the previous year, he was up 174%. So in 1998, he was up 174%, and our portfolio was pretty boring. So the doctor put the money in with his kid's portfolio, and he was investing it online at the time. And you know what happened with that portfolio. And I talked to him a couple years later, if you remember, through 2000 to 2002, the NASDAQ was down like 80%, 75, 80% from the high point. Some of these names on the portfolio that his son, who was a whiz kid at 24, picking these companies you hadn't heard of, this was the .com era, were companies I didn't even know who they were. Cisco was one, I remember that, but the rest, a lot of them were just companies we didn't know about. I did talk to him a couple years later. He pretty much lost most of that $1 million. Part of it was because when it started to decline, he said he went on leverage a little bit and margined it. So the kid was a genius because he was just picking stocks out of a hat, made 174% in 2018, but lost all the money a couple years later. So we've seen it before. This is definitely different because these companies have earnings, but there's definitely some room for caution.
What do you make of, I guess everything that's going on with tech leads me to kind of another area that I think is of a lot of interest to clients, and that's we're going to see some pretty substantive IPOs this year.
Right.
Right. And on the AI side, we don't have definitive timelines yet, but Anthropic and OpenAI are a big topic, and then SpaceX obviously is impending.
Right.
And when I think about 1999 and kind of the tech bubble, and you're talking about companies that have these insane valuations, but in many cases were not profitable or didn't have any, real revenue to speak of. Things are different, but were the valuations as stretched on something like a SpaceX or an Anthropic, where even though they're generating billions of dollars of revenue, they're getting valuations that are, I think the latest for Anthropic was $900 billion. I think SpaceX is somewhere between $1.5 to $2 trillion. They're anticipating the valuation of the company at. Doesn't that seem?
It seems crazy.
Nuts?
I mean, so I have some chart in front of me. Good segue, because I think the second word that could be our theme word, we said parabolic. That's a fun word. You're hearing about it on CNBC and Bloomberg a lot because the technology has made a parabolic move. The other thing could be supply, and we have a crazy amount of supply of IPOs. Okay, and you and I were talking just before the call, and we're looking up like what was the largest IPO ever, and I think Alibaba was like 21 billion. That was it.
Saudi Aramco was right around there too, at like 24, 25.
Right. So now just over the next month, here's the list here. So you have SpaceX, 75 billion. They're raising 75 billion, right? Google, Google's not already publicly traded, but Google just announced $85 billion secondary offering. They have Berkshire Hathaway investing $10 billion in Google. This is Greg Abel, the new CEO, his first big move. Warren Buffett took a back seat, retired. Now he's making some big moves. So he's putting $10 billion in Google, but they're raising another $75 billion. Okay, Anthropic that you mentioned I think they're coming out at around. They're looking at $75 billion. By the way, we were looking through some of their valuations. Their valuation is doubled. They had an offering just last month, right? That was at $65 billion, which doubled. That came out of valuation at double what it was in their round just February of 2026. So it doubled from February 2026 from last month, and now it's going to be way higher this month. And then you mentioned OpenAI. That might be. I think you know more about this than I do, but OpenAI, which is ChatGPT, and then Anthropic, which is Claude. They seem like they're in a race to try and beat each other to the market. Yep. But OpenAI might be $100 billion.
Yeah,
these are all the biggest in history, all in the next couple months.
They're absolutely monster IPOs, and it's funny. SpaceX was a similar story. I was just looking at valuations over the past couple of years. So like mid 2024, private valuation was 200 to 210 billion. December of 2025, they did a secondary share sale at 420 a share. That was a $800 billion valuation. February, when they did the XAI merger, that brought the valuation up, over 1.25 trillion. And then now the way they're pricing this IPO, with the prospectus data that we have, it's targeting a valuation between 1.5 to 1.75 trillion. And, there's some real businesses in there. Starlink, for example, generated roughly 11 billion of SpaceX's total 18 billion in revenue for 2025. But, $18 billion on an almost $2 trillion valuation, the math seems interesting to me.
Yeah, and there's something in there. Elon Musk has some bonus if there's more than 100 people, or 1 million people, living in Mars at a certain time. He's got a bonus.
Yeah, right? And I think it's like $1 trillion bonus.
Yeah, it's $1 trillion bonus. All he has to do is get 1 million people into a Mars station. So that sounds pretty easy.
The other interesting
thing, should be able
thing
to do that over the next couple of years
about some of these IPOs as well is just that things have changed, right? So there used to be, when companies would go public, there would be what we'd call like a seasoning period, where they had to be profitable a certain amount of time to start getting listed inside the indexes. And some of that has changed, right? And also the other big thing that has changed is it used to be when a company came public, maybe not all of their shares, but a significant portion of their shares would be part of what we call like the float, or the actual tradable marketplace. And in the case of SpaceX and some of these others, you might see a float in the marketplace of like 5% of the total outstanding shares.
Right.
Right. Which is, it's wild. And it's not the first time that, the NASDAQ or the S&P or the Russell or whatnot have adjusted their rule set, but it is a pretty shocking set of adjustments this time around. I mean, they got rid of another, S&P, for example, removed what they call the dual class share restriction, which, you couldn't have a founder that had what they called like super shares or super voting shares, and then the public only gets the non-voting shares.
Right.
They just threw it out,
right,
and said, that's fine. So I think even though not only just the size of the IPOs, but the dynamics in the IPO market have changed so fundamentally that it'll be interesting to see how this goes forward. Does this now act as a blueprint for every company to come out and say, hey, we'll have some public shares that are available, but all the real voting power we're going to take out of the public markets.
Interesting. Yeah, and so it's a great deal for the financial companies like Goldman Sachs and Morgan Stanley, because these you can imagine underwriting fees on some of these mammoth deals that are coming out, and it just feels like definitely there's always Warren Buffett talks about greed and fear, right? It just feels like there's a lot of greed that's really overtaking fear right now, and that can always extend a rally in the market that people jump towards what has already moved up a lot. So definitely room for caution.
Yeah, and it's however, all this said, right? Then we looked at the Michigan Consumer Sentiment Survey. Right. That had its lowest reading ever. Right. Which is historically, that would be a bullish, contraindicator for the market, and say that, hey, the consumers are fearful and uncertain. That's probably a good time. However, the market's also, I don't want to say it's exuberant, but it's, certain aspects of the market certainly feel that way. So it's a weird dichotomy right now. And then you have, kind of looking at the overall economy. You've got AI spend, hyperscalers, tech investment, and then you've got everything else. So we have all these weird cross currents going on.
Yeah, I mean, it's definitely the K-shaped economy, and you're right about, if you look at the University of Michigan Consumer Sentiment Study, which comes out monthly, and they've been doing that for 75 years. It's one of the lowest in history, but a lot of that is people that are, that aren't necessarily investors, right? Yep. That are involved in it. And even if they are investors, they're not involved with these IPOs, right? These large IPOs. It's hard for although SpaceX, they are reserving something like 30% for retail investors. So we'll see how that distribution gets kind of laid out, because the other ones have been difficult, to say the least, for individuals to participate.
Yeah. On that K-shaped economy front, I saw an interesting stat. It was like 10% of U.S. earners now account for roughly 49% of all consumer spending.
Wow. Okay. Not surprising. Yeah. And that's, this is a spillover from gains in the market. Keeps the real estate going. Speaking of that, I think if the SpaceX stock gets to 138, I think they announced they're going to price it at 135. That would put Elon Musk at the first $1 trillion individual, not $1 trillion company, $1 trillion person. So it's pretty amazing to see. And then if he gets that station on Mars in a couple of years with 1 billion people,
and then he can be a $2 trillionaire.
He can be a two trillionaire.
At this point, I think you look at some of the net worths of our richest individuals on the planet, it would make like, John Rockefeller and J.P. Morgan and the Astors blush.
Right.
I mean, it is truly we are,
and much larger than all other stock markets. If you look at market caps on stock markets, right?
Yeah, I mean, you look at NVIDIA. What was it? I mean, it's bigger than the entire. What was it, like Australia and like multiple countries together? So
just one
company,
just one. And we're definitely seeing it pull along other more conservative tech stocks like Apple. Apple's made a nice move. I noticed yesterday Apple stock has been up 11 weeks in a row. So that's.
I mean, look at the sleepy, DRAM companies, SanDisk and Seagate, and look at the absolutely astronomical rise those have had, right? And you saw, Jensen Huang the other day, at that conference in Taiwan. Now they're moving. They really were exclusively on the GPU, the graphical processing unit side of the market. They're doing CPU chips now. Again, I think that AI does absolutely have a potential to be kind of like another industrial type revolution.
Right.
But in the short term, some of these moves are really breathtaking.
So we'll have to monitor it to see that supply issue. If all that money that's coming into these IPOs, it's got to come from somewhere. Does it come from the other tech stocks itself? Yeah. There is I was looking at the numbers the other day. There's still over $7 trillion in money market funds. So maybe some of the supply could come from money that's in the money market that's still been out of the market. It's hard for me to believe that money, though, is due to come into the IPOs, because that money's been sitting there for a while. The money market balance has been high for a while.
I mean, I wouldn't be, to your point, I wouldn't be surprised to see selling in some of the big names that have run up, NVIDIA, AMD, et cetera, where some of the more sophisticated managers are maybe taking money offline for that, or certainly on the retail side. They're easy stocks to kind of trim from.
All right, let's do something fun, because you mentioned yesterday. I thought it was fun to do the young investors, and we've been doing this a while. When a couple of the young investors were grandchildren of some of my clients, but that's useful. So we talked a fun story that Dan shared. I'll kind of tee it up a bit. He shared yesterday was about compounding, and I thought I had mentioned it. I've been for the last 3 nights. I've been at 2 charitable events and then a client dinner. So I'd shared this with people, and we had a good time kind of laughing about it. And it was a story about compounding. So he got the right answer. I was picking on Joe, our producer here from the studio, and he got the right answer. And I said, Joe, so this is fun for you during the summer to ask some of your family or friends. They have a choice to make, and this is a story of compounding. So the story is, if I gave you a choice, you could receive $1 million today. So you get a $1 million lump sum. Or second choice would be, or I could give you a penny a day for a month. So for 30 days, I give you a penny a day. But what I'll do is, on that penny a day, I'll double it every day. So Dan, what would you choose if this story?
I might be cheating here, but if I didn't know what I was doing, I would say, well, $1 million versus a penny. Absolutely, you got to take that.
And Joe got the right answer because he heard it before, but he knew something was off with.
Yeah, but if I had picked $1 million, I would be in a really bad way at the end of the month, because that penny ends up growing north of $10.7 million by the 31st
just
day.
By doubling every day.
And it's funny. You take the million. The first week you're feeling pretty good. After 10 days you're looking at it and saying, hey, I got $1 million, and that guy that took the penny, he's only got, a little over $5. You go 20 days out, you're still feeling great. You've got $1 million. Your partner in crime here has $5,000. And then really that last 11-day period, the power of compounding really kicks in and things start to accelerate precipitously.
Right. Yeah, you're right. On day 25, you're still at 167,000. That money grows to 167,000. And then it starts to really compound from there. Day 30, 5.3 million. And then if it's a 31-day month, it's, $10 million. It's kind of amazing. And we, in some cases for clients that are watching this podcast, we're preaching to the choir, because they've known that, because they've had, a lot of our wealthier clients were not necessarily the high earners. They were the high savers, people that just kind of chipped away through the years.
And they use their biggest currency that all of us have in finite supply, and that's time. And it's a fun story to share with your family as you're heading into the summertime and you're having conversations, and especially our clients that have, kids that are in college or about to enter the workforce. It becomes, one of those things where you're always deciding, like, oh, retirement seems so far away into the future. Why would I save for that now? And even a really modest amount of saving, given enough time to grow, turns into a pretty phenomenal nest egg. I mean, we were, one of the other stories we always talk about, our comparisons we do, is like a 25-year-old that
Yeah, share that
saves.
one. That's a good one. The
Yeah.
25-year-old compared to starting at 35. waiting 10
So
years.
just,
Share that story.
for that 25-year-old, let's say from 25 to 35, they save $3,000 a year versus their coworker that doesn't save in their 20s, starts at 35, and then saves from 35 to 65. You would think, well, again, the 35-year-old saves for 3 times as much.
Right.
They clearly have to come out ahead. And just the way the math works with compounding, the 25-year-old that stopped saving at 35, they end up, I think it was like 300 and let's call 70,000 around numbers
Right.
versus 310,000. That was assuming a little over a 7% rate of return. So you put in 30,000 of your own money, you end up with 370 versus your coworker that put in 90,000 of their own money and ended up with 310,000.
Yeah.
It's just, again, these are not the most advanced concepts, but I think all of us lose sight at times. Compounding really is the eighth wonder of the world.
Yeah, and I think it's important to bring back a boring. It's not so boring. I think it was Einstein that said it was like one of the world wonders, compound interest. So, but it's a good to think about slow and steady kind of wins the race when it comes to investing. And I think we could all use a reminder right now because we're in this greed is replacing fear type of market with tech stocks going parabolic that, might be a good time to focus on your dividend portfolios and some of the more boring sectors of the market. Let's give one more fun story because, again, it's summertime. But another way, if you don't like that story on the $1 million, I know there's a lot of golfers that watch our thing, but another fun bet would be, Dan, if you took me out to play golf and to make it interesting, you said, hey, let's bet 10 cents a hole for 18 holes, right? I'd probably do it. But and then if you said, hey, let's make it interesting and double the 10 cents, so a dime a hole, let's double that every hole, I'd probably still be into it because initially I'd be thinking, a dime a hole and probably can only lose what's $1.80 for 18 holes, right? But by doubling it, again, it's same as the $1 million story. It kind of gets crazy. I have the chart in front of me. And again, after 9 holes, I'm still in pretty good shape, although I lost 9 holes in a row, but I owe you $25.60. Not too bad. But by the 18th hole, I owe you over $13,000 for my 10-cent bet.
Well, and I guess at that scenario, maybe we're not stopping after the round and having a meal and some drinks together. We're probably not talking at that point.
Right. Yeah. By the time because when it gets over 1,000, which would be on the 15th hole, by then I'd stop talking to you, right? Yeah. Because I was in for I thought I was in for $1.80. Now
the good news, if you ever take that bet against me in golf, it'll probably work out in your favor because I don't think I'm winning any golf matches anytime soon.
Yeah, well, I'll probably win a couple holes, depending on who.
So maybe it only costs you a couple $1,000.
Right. So that's the message for today. Is a message of prudence. It's a good time during the summer to take a look at your portfolio, and we have been going through. Again, I mentioned preaching to the choir. Most people watching this podcast are not overloaded in these very, very aggressive types of stocks. In some cases, I wish you were. We do have some people in the AI portfolio that have done pretty great on those, but it's just a time of prudence to maybe do some trimming there in some of the technology sectors and maybe look at some other sectors that are undervalued.
Absolutely, I think that's well said. And summertime, we always kind of harp on this, but it's a great time for introspection and, in all aspects of life, but certainly, for a financially minded crowd that's watching this podcast, it's a good time to sit back, take stock, review, and, just make sure things are still aligned with your goals.
Yeah, and it could be an interesting summer and a volatile summer because we have a couple things happening. We haven't talked about the Fed, but we have a new Fed governor, and they tend to test the new Fed governor, so we'll see how that goes over the summer months. We'll see. His first meeting is June 17th.
Yeah.
So we'll see. I think there might be less talk coming out of the Fed, maybe less press conferences. We'll see how he handles that. And we also have later in the summer, we have to worry about midterm elections results coming out. So we have two things to think about there.
Yeah, and on the Fed front, I'll leave with one quick note. Again, coming into this year, there was a lot of talk about cuts in the back half. And, just like to check the CME Group, their Fed Watch tracker, for this first meeting for Chairman Warsh, 96% of market participants are expecting no change. Not a huge surprise there. But then what I think was interesting is I look at the December meeting. If you looked at this at the beginning of the year, it'd probably be a 99%
The market was
likelihood of a cut.
pricing in 3 cuts at the beginning of the year, right?
Right now, it's looking at no change, 46.8, or a hike at 51.5%, which is a
Quite a change.
wild change. Yeah.
So we'll keep you up to date. As always, we're here for you. If you have need any questions, we're going to have for the clients. We're going to do a webinar next week, which can be a little bit more interactive. It allows for clients to send in questions. So with that, I wish you all great summer, and we will see you next month.
Catch you on the next one.
Cornerstone Private Wealth is an independent financial firm helping individuals create retirement strategies using a variety of financial and insurance products to custom suit their needs and objectives. Cornerstone Private Wealth Partners provides all investment advisory services through Concurrent Investment Advisors, LLC, an SEC-registered investment advisor. Concurrent Investment Partners, LLC, DBA, Cornerstone Private Wealth are not affiliated companies. The items discussed are the views of the presenters and not of Concurrent Investment Advisors, LLC. The information provided in this podcast is for informational and/or educational purposes only and is not in any way to be considered investment advice nor a recommendation of any investment product. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be more or less than originally invested. Concurrent Investment Advisors, LLC and Cornerstone Private Wealth is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. Please consult with your attorney, accountant, or tax advisor based solely on your individual circumstances.